Hi, this is Robin N. Welcome to Zoom Out with Toza Says. This is part 2 of my Q3 2023 outlook. We will be talking about what's ahead in the second half of 2023. So again, disclaimers, this is not investment advice. I am biased, I have blind spots. This is for your entertainment only. This is not investment advice. So take for it what you will. So let's get in here. What's ahead for 2023? Let's start with the government. So here's the broad picture. The red is tax receipts here, and these are the spending. So this is income and spending, and we have a $2 trillion plus gap already. Going forward, this gap is going to widen, as even if you get more income, the expenses on paying for Social Security, Medicare, and defense, and then the brown here is also growing very rapidly. This is the cost of borrowing so much money by selling U.S. Treasury bonds. So this is not a very attractive look going forward for the United States. This is relevant because how much the U.S. issues in new treasuries every year is a very important factor in how much it costs. Obviously, when you issue a lot of it, the buyers need to be wanting to buy it. If they don't feel like buying it, you have to raise the interest rates to incentivize them to buy it. And we're talking about US domestic buyers as well as foreign and foreign government buyers. So the amount of new treasuries, because we had this debt ceiling crisis that we resolved finally in June, raising the debt ceiling, allowing the government to go ahead and sell new treasury bonds again. Now they have to catch up. So the second half of 2023 will be a massive amount of US treasuries that need to be sold and transacted. So this is an important factor in the global economic machine. As we see a new level of bonds being sold, we're seeing yields on these treasuries start to rise and rise very rapidly. Now, to put that in context, the government, the treasury, they have a plan. They say we're going to sell some that are short term and some that are medium term and some that are longer term. So they have a full range of different durations of US Treasury bonds that they can sell. And to be extremely geeky about this, the shorter ones are called bills. The medium term ones up to 10 years are called notes. And then 10 plus years, those are called bonds. So US Treasury bonds, US Treasury notes, US Treasury bills, okay? And how they make that mix has a big impact on how the markets react to yields and changes in supply and demand. So what we've seen is they have issued a lot of the short-term bills. And that, because of the mechanics of how the financial markets work, hasn't had much of an impact. That people still want them. Very short-term bills are paying up to like 5%, which is like a no-brainer. You lend the government money for 3 months, you get 5%. That's fabulous, right? The further you go out on the time frame, it makes the decision making based on future forecasts of inflation and economic growth. And because of that, a 2% or 3% treasury note or bond that you lend the government for 2 or 3%, that doesn't seem that attractive, especially if you think inflation is going to start to rise again and the Fed needs to keep raising interest rates. So we're seeing here, this is as of August 17, US Treasury 10-year yields have jumped extremely high. We're now up at the 4.2, 4.3% range. And this is very impactful because it impacts mortgage rates. It impacts also the incentives of, do I buy bonds or do I buy stocks? Because with the U.S. Treasury bond, at least it's AAA quality. It's essentially guaranteed. It's essentially risk-free. Do you take 4% guaranteed risk-free, or do you take the risks of a market that's already extremely high? So when you think about those factors, this impacts how much money is flowing into stock markets or bond markets. Behind the scenes, there's also a lot of stuff going on. This is very wonky Fed stuff, but also the Treasury has started a couple of new programs. One is this Treasury buyback program, which they don't really talk about, don't really announce, but it's there, it's real. They're buying back some of the bonds. And to what purpose? Essentially, this is a stealth yield curve control mechanism, where they're going to buy back some things to try to keep yields at a certain range. Okay. On top of that, this is pretty exciting. The Fed Now program just launched, I think, in July. This is essentially for the back end of the financial system in the U.S. They're using blockchain digital payments. So essentially, it's a cryptocurrency of the United States dollar that's working in the back end. They're testing it out. They're working it, making sure it's robust enough to go lifetime prime. But it's happening. Crypto US dollars are now a thing, and it's working in the background. There are a lot of benefits to this, but also a lot of things we need to worry about. Specifically, if it evolves into something where I'm paying you through my Venmo in dollars, and the government is using this as a FedNow platform of using crypto US dollars, essentially they're going to be able to track every single transaction that everybody in the United States makes. That could be good, that could be bad. There are a lot of things that people are worried about. So anyways, we'll talk about that some other day. Meanwhile, when the banking crisis happened in February, March, this was another stealth liquidity program that the Fed and Treasury created. It's I forget what the acronyms stand for, BTFP. So yeah, it didn't exist until March, and then banks have this channel, this window to try to protect their assets from getting downgraded or undercut by market prices. And unfortunately, the small to mid-sized banks in the US have been ramping up and have kept using this program in order to protect themselves from a crisis. So that's actually not a healthy thing to see, that this bucket is being used still into August. So what this tells me is the banks are still under duress. Okay, so keep that in mind. Consumers, going forward, we talked about the student loan repayments and what this means. Somebody has done a forecast. They believe that's like $15 billion a month of less spending that the economy can receive, because that money has to go towards paying their student loans. There is something that Biden has been talking about, giving relief to over 800,000 student loan borrowers. This applies to people who have already paid 20 to 25 years of their student loan. So it's a smaller population, and it only amounts to about 39 billion of the roughly 1.5 trillion of outstanding student loans. So if this gets enacted, if this doesn't get blocked by Congress or the Supreme Court, yes, it's wonderful for some student loan borrowers, but the majority of the student loan borrowers are still going to be on the hook to pay their student loans. Inflation adjusted wages. So over the last 2 decades, this has just remained flat to low. We did get the bump from COVID, and the government gave free money basically, so everybody got a chunk of money. But then inflation happened, so now every dollar that we got didn't catch up with inflation spending. Well, now inflation's come down from 9% down to about 3 or 4%, and wages have been rising. So now we're again a little bit positive, but unfortunately that little tick down doesn't look good to me. Inflation, if it keeps rising, whereas the job market softens going forward, we could still have this being essentially zero. So this is not a good look for consumers and the average American citizen who is trying to make ends meet. Unfortunately, permanent job losses year to year have remained kind of sticky, and it's risen a little bit towards over the last couple of years. We're seeing retail sales peter off and go flat. We're seeing cardboard boxes. This industry has often been used as a leading indicator of how the economy is going. When you don't buy stuff, you don't need cardboard boxes, essentially. And so we definitely on the cardboard box index, we're definitely already in a recessionary signal here. So that's not a good thing. Interestingly, the Atlanta Fed does a nowcast of their GDP, and they are forecasting for Q3 2023 a 5.8% GDP growth rate, which is stunning. I think the Cleveland Fed has it somewhere around 1% or something like that. So there's a lot of noise in these data signals from the economy. This is quite stunning. I think it has to do a lot with inventories and other factors like that. There's definitely a lot of traveling going on, especially international travel. I think this was definitely a last hurrah for a lot of people to get out and enjoy a family vacation somewhere. So these could all be factors, but it's a very confusing mix of signals for the Fed, for economists, for us as investors to figure out what's really going on. Are wages going to come up or down, or is unemployment going to go up or down? Okay, so I wanted to show this to keep this in mind for everyone. So going on to more details on inflation, again, it rose July, August to the surprise of a lot of people. Not a lot, but it's weird. A lot of people have expected inflation to come down. Oil prices came down. All the supply chain bottlenecks came down. Consumers were still spending, et cetera, et cetera. One of the key components of inflation, the way we calculate it in the US, is shelter, which is roughly 30 to 35% weighting of how they calculate inflation. So that's kind of bothersome to see that, because a lot of economists and Wall Street economists have been expecting inflation to just keep going down to 2%. I have never believed that. I think if you look back to the things I've said, I always thought it'd be sticky around 4. So we'll see how this evolves. We're seeing little bits of signals from the different indexes that inflation is starting to pick back up. So we'll see if more and more of those pop up. Getting to the inflation on the shelter side, for one, it's a very, very lagging indicator. They don't take this data frequently, so it's really kind of slow, and we don't really know until it happens. But from Redfin, that tracks this more frequently, they're saying, the rents, how would we say this? This is the year-to-year change. So the change in rising rents is definitely slowed down. People aren't raising rents super fast as they were in 2021. However, what you actually pay for rent really didn't change that much. It's not like rents deflated, that the rents went down. So this is still the price that you're still paying to rent a place. And it's actually risen a little bit towards the end of in the beginning of this year, let's say. So this ends up being rather sticky and inflationary for the inflation calculation. And this could be a main factor why inflation could be going sideways for a while right now. And then we'll watch to see the other things. Sadly, the oil market, in the US, the stockpiles of our oil reserves has completely fallen to the bottom range, which is not a good thing. Okay, globally, it's falling to the bottom range. Just inventories. This is interesting. It's onshore plus oil on the water. That means like on tankers, in transit, or some tankers just sitting out there, just sitting around till oil prices are nice, and then they try to find a buyer. Globally, we're at a very low inventory scenario. And, this is very wonky. This is the periodic table of oil. So we think of oil as, maybe WTI or Brent or something like that. in reality, there's you know, dozens of different types of oil, from sweet to heavy. They are all produced in different regions. And the thing that I think a lot of people don't realize is refineries are only able to deal with one kind or the other. So if it's sweet and light, refineries can process that, but it cannot process the heavy crudes, and vice versa. So this is a very interesting thing where there's a lot of bottlenecks on the refineries, and they also determine very much what the prices of gasoline, diesel, jet fuel, what those will be, because it's a bottleneck. And in the US, we haven't built a new refinery in 20, 30 years, just environmental factors, cost factors, etc. So those bottlenecks are there. If they break down, you're going to have higher oil prices, period. Yeah. Interesting, for most of the US is working on the heavy crudes, even though the US digs up and produces the light crudes. All the shale oil is sweet and light, but the US needs heavy crudes because that's where our refiners process. Okay. In any case, what you're seeing is, even in the Permian Basin and other places in the US, the fracking oil rigs, the number of rigs that are out there is just declining. You know, it's not highly incentivized right now for those guys to go and spend the money and dig more, produce more oil. So this is a global picture. The US is the light gray. It's just going down, and globally it's just going, sideways, if not a little bit down. Why is that? There's when you think as an oil producer, you're running out of labor, the skilled labor that helps you drill these rigs. They're hard to find, so the costs of all that went up. There's headwinds from the government. Essentially, policy is against carbon energy sources. So even banks just prefer not to lend to these guys. And for the oil guys, they are saying essentially, well, look, if it's all against us, it costs me billions of dollars to go and produce more oil. I don't want to borrow for 10 years because the banks may not even want to lend it to me. And essentially, the U.S. government and the world, climate friendly people have put in policies that are against me. And so the energy producers are more than happy to enjoy the high prices and high profit margins right now without going out and digging up more oil or natural gas. So that's kind of the framework that we have and can expect going forward. Okay. And on top of that, we have OPEC plus. OPEC plus, the plus is Russia. They get together and they prefer higher oil prices, obviously. So they are saying, hey, the economy doesn't look good. There's world recession. Demand's probably down. So we're going to lower production. We're going to export less. And so they have joined together and have been cutting oil production globally. And that is also another factor of why oil prices probably won't fall much going forward. The other side is the demand side, and I think this has surprised a lot of people that even within the US, oil demand for diesel, for gasoline, for jet fuel has actually poked up to a record high recently. And globally, this is the estimates going into 2050. It's very, very unlikely that we use less oil even over the next 20, 30 years. If not, we maybe even have high growth rates. And, thinking of the emerging countries where they used to be riding bicycles and now they've upgraded to scooters, and then they want a car, and then they want a bigger car. Those kind of factors, if they are gasoline based, they could continue to drive demand all the way into 2050. So let's assume the worst case, that just goes sideways. The sideways demand curve versus the falling supply curve, you're still going to end up probably with relatively high energy prices. Okay, and even now in the US, gasoline prices at the pump, we had that big that spike in 2022, and now they've come all the way back up, from the last high in October 2022. So if we were to guess, I would guess this would go sideways or up. I don't see where we have extra oil and refining capacity to keep oil prices down. On top of that, one of the things that Biden did was he released the Strategic Petroleum Reserves, which is the US's piggy bank for oil in case of war and emergencies. We've brought that down. We've basically sold off the inventory, so there's only now a third of the inventory that was originally there. It's unlikely that he will drain to zero, and so we're not probably able to expect the government to help us with oil prices in this next year. So that's another factor why oil prices, gasoline prices, inflation could be sticky and in fact go back up. Okay. And this is just a funny chart I found about petroleum engineering degrees where there's a 75% decline. There are no young people in this space right now. And that is also a concern in case we actually need to go and dig up more oil. Okay, that was energy. The global stock of wheat here is also a little bit concerning. It's not in danger zone, but it's definitely not growing. We've seen a lot of climate issues in the world. If we look at the US, here's the drought monitor, here's some corn, this is the soybeans. We're getting weird weather patterns. This is like hurricane heat wave of hot Pacific Ocean water. This is to them a category 4 extreme marine heat wave that's just right off the coast of California and Oregon and the US West Coast. That's the Pacific, now North Atlantic. So the Atlantic Ocean temperatures are also just spiking into all-time highs. That's really concerning. So when we look globally, it's just crazy heat there, crazy heat in the Atlantic. This is concerning if you ever watched that movie called, what was it, Day After Tomorrow, where climate disaster, this ocean current flow gets too hot and it breaks down and it causes an incredible ice age. It probably won't happen like that, but this is something that actually is evolving in the real world. So they will produce weird weather patterns, especially for Europe and Russia, which are major producers of agriculture. And therefore we're looking at a strange thing where I believe commodity prices in aggregate, which means energy, agriculture, and the metals, we could be on a new cycle, perhaps even a super cycle for commodity demand and prices. Okay. And real quickly, we'll end here with some trigger events that I can see coming up. The first is that we have this Jackson Hole Symposium in Wyoming. This is the big global central banker, how would you say, social gathering event. So we have the Fed central bankers and the European central bankers and the Japanese central bankers. They all get together here to drink nice wines and chat about things, but they usually discuss some things behind the doors of their concerns. And oftentimes the Fed will come out after some of their wine drinking and say, hey, we think this, hey, we think that. So we don't really know what will come out of that. We just know it could become a critical central bank announcement or indication of hawkishness or dovishness. Given that inflation remains sticky, at least from July to August, and given that unemployment in the US actually went down to 3.5%, so all the tightening that the Fed has done, all of the interest rate hikes that the Fed has done, GDP also doesn't look like it's coming down into a recession. It kind of gives at least the US Fed a lot more room to continue raising interest rates, because what they've done, despite it being the highest, fastest rate hikes in the history of the United States, it hasn't slowed the economy. And because of that, it won't slow inflation. And that is the mandate for the Fed, is to watch unemployment and inflation. And with neither of them, inflation's come down, but it's not dead. It hasn't come down to the 2% target that they set. Meanwhile, unemployment doesn't look like it's causing job losses. So the Fed could very well continue to act very hawkish. They could continue to slowly hike interest rates just to get it further on to tighten down on inflation. And we'll see how that works. Conversely, for the Fed, though, they're not concerned with the US budget deficit. That's for the Treasury. But the Treasury definitely has pressure, as now interest, the money owed to pay all the interest on all the debt has climbed over $1 trillion. So that's extremely concerning when you think that we spend more on paying people back rather than paying for weapons and defense, which is already a huge budget item. That's not a healthy trend. So we'll see how that goes. Smaller events that may happen: Ukraine Independence Day, August 24. It could be a cause for both either Ukraine or Russia to do something big. The El Nino harvest season will be in September. Let's see how all the weather patterns affect crop output. What is of concern to one guy that I've been listening to, is seems pretty smart about climate and agriculture. If we get a lot of wetness in the US during harvesting season, a lot of crops will be destroyed. So you have to have rainwater at the right time. And when they're finishing their crops, they don't want to get flooded. It'll destroy the crops. Things like that are to be watched. So there is concern, as we know there's a hurricane moving up the coast from Mexico to California. And there's going to be a lot of rain, flooding that's going to happen because of that. The California crops could very well be a little bit under duress. We'll see how the Midwest crops go. Obviously, the Fed meeting in September is a very pivotal, important one. So whether they raise interest rates or not is very important. And then there is a budget showdown in Congress October 2nd that we need to kind of worry about, in case the bipartisan things happen to the extreme and nobody can agree. You could see a shutdown of the government again. So let's watch out for that. One interesting thing that's happened recently, the Argentinian presidential election, the primaries went on, and the guy that has the most votes right now is a libertarian, independent, kind of a little bit of radical kind of figure. And he basically sounds like a little bit of scorched earth. We got to get rid of the central banks. We're going to convert our currency back to US dollar base, et cetera, et cetera. It could be extremely disruptive for South America and for Argentina, which is a huge producer of agricultures and energy. So we'll watch that. What's happened in the last week, literally the last week, China is really, it sounds like it's imploding. Major companies with major default risks going on at the same time. So the US shutdown, yikes, if that happens, and we're going to see how that evolves, but it's on the radar. China's largest property developer has missed payments on some of their debt already. The second largest property, literally just yesterday, announced Chapter 15 bankruptcy in the US. So they are definitely they were already under duress. And the timing of this is very, very bad, that they would announce bankruptcy now while its bigger competitor is having major issues. Meanwhile, in China, we probably don't know this as much, but they have a whole huge shadow banking world. So aside from the banks that get regulated by the central bank, there are these trust and wealth managers that aggregate a lot of money from the citizens, and they promise almost double the savings rates as the banks. So they attract a lot of money, and they're not highly regulated. And what you're seeing now is one of the top wealth managers in China is missing payments on some of the products that they sold. And when you dig in deeper, you're realizing that they weren't well regulated, and they probably invested in distressed assets of, you know, a lot of these property developers, because that was the foundation of China's wealth and financial system. So if this goes wrong, this sounds like a daisy chain of events that could go really wrong. And you know, there are things that the government can do, but they're trying to avoid stepping in completely and intervening and stimulating things. But my feeling right now is this is going to grow into bigger proportions, and it's going to force the government of China to make some big radical changes. So you're seeing that they're suppressing economic data. They don't want anybody else to know that youth unemployment in China is over 20%. They've visited some of the people who are protesting this wealth manager. The police have visited and said, hey, you know, don't go out publicly protesting, please. That's a little bit scary. They have been telling banks to release more funds, lend more. They've been telling other wealth managers and banks also to support the stock market. They've told the top 25 companies listed on the stock market in Shanghai to, hey, maybe you want to do some buybacks. They're wanting a lot of these things to go on to try to prop up at least the stock market, it seems, to try to keep this from blowing out of proportions. But given the earlier slides that I've shown you, I mean, China is under duress. The economy is really slowed. Exports and imports into China, out of China, have all slowed. They're under some serious pressure. And unfortunately, this may have global repercussions. So we'll see how that evolves. All right, that's it for what's ahead that I'm seeing. Stay tuned for part 3, the crystal ball portion, which I will be preparing shortly. All right, cheers.